U.S. markets traded mixed, as you saw, even though January job numbers exceeded expectations. So is the U.S. economy finally gaining some real momentum? Let's go to Doug Peta. He's chief U.S. investment strategist at BCA Research. Thanks for joining us today.
Thank you, Morel.
What do you think is reviving job growth in the U.S.?
Well, it's only been 1 month, so we shouldn't get carried away that January was strong. It was 130,000 net payrolls additions versus an expectation for 65,000. It was the first number we saw above 100,000 since the very beginning of 2025. But it is only 1 month, and this number will be revised 2 more times before it is finally in the books. So I think today's jobs number was encouraging. It shows some potential for the hiring freeze that was in place really across almost all of 2025 could be beginning to lift, but we can't say for sure yet.
Okay, talk to me about the revised numbers, because we had them released from last year. That number was released. And I want to know what those revised or those revisions tell you about the state of the American economy.
So I think markets were right to kind of look through the revisions today, at least for one-day performance, and focus on, again, at least at the outset of the day, that the January numbers were better than expected. We got roughly 860,000 downward revisions in net employment as of December. And markets were expecting around 900,000 down. So it really didn't affect markets today. But one thing that I do think was significant in the revisions is that we discovered the concentration in job creation in 2025, which we already knew had been heavily focused on healthcare and social assistance, got even more concentrated. So before these revisions, we thought for the year, without healthcare and social assistance, the U.S. economy had lost 125,000 jobs. Well, it turns out after the revisions, without healthcare and social assistance, the U.S. economy shed 500,000 jobs in 2025. So it's not a great sign for hiring that almost all of the job creation activity is concentrated in one very narrow space, and that additionally, that space is acyclical. Healthcare really doesn't have anything to do with the business cycle. We think it's about the aging of the U.S. population that is driving increased healthcare spending and increased healthcare hiring, and counter-cyclical social assistance. The social assistance hiring is largely in things like food banks to help the needy. That is counter-cyclical. The fact that we're hiring at a rapid clip for social assistance suggests that the economy is not doing very well, that the business cycle is maybe faltering a bit.
Okay, so talk to me a little bit about the consumption side of things. We keep hearing about the K-shaped economy, where those with more money are spending and those with less money are definitely not. Is that where we still are? And do you anticipate a shift now that we have the January numbers?
I would argue that while the K-shaped economy is an apt description of bifurcation between households, of the gap between households, I think that the spending, we couldn't have consumption holding up if the middle class broadly wasn't spending. The very high end just isn't big enough to carry the entire economy. It needs help from the households in the broad middle. One would think that without job growth, without compensation income, that the broad middle wouldn't be able to spend. But it looks to us like equity ownership of stocks has become so much larger, so much of a larger share of household wealth across the income and wealth distribution. It's not just the wealthiest households. It's not just the households that earn the most that have seen stocks as a share of their wealth rise. It's really everybody. And as the middle class has seen the value of their stock holdings come to comprise so much of a larger share of their wealth, I think that that's allowing the broad middle to dip into brokerage account gains to keep consuming, despite the fact that income growth has been pretty weak. And we would expect that that's going to continue because this equity wealth has been building up for a long time, and it's now large enough that it can really help offset shortfalls in income when stocks are rising.
Okay. Last question here on whether or not the revision or the new numbers from January affect the rate cut path.
We don't think they do, other than it likely reduces the probability that we will get rate cuts in the first half of 2026. We still believe that we're going to get more rate cuts than are priced in the second half of 2026, because we believe that inflation is well on its way to getting back to the Fed's 2% target by the end of the year, because we expect, now that the tariffs have washed through, that you're going to see goods prices actually deflate, fall year over year, just like they typically have since China joined the World Trade Organization in 2000, and because there is a whole lot of apartment supply still in the pipeline that we think is going to drive down shelter inflation. And shelter inflation is 40% of core CPI. It's better than 30% of core PCE.
Doug Peta, I got to leave it there, sir. Thank you for joining us.